Hi, I'm Shae Russell from ABC Bullion, and joining me today is Nick Frappell, Global General Manager of ABC Bullion. Nick, how are you, mate?
Hi, Shae. Pretty well, thank you very much.
Now, thank you very much for joining me. I'm so glad that we can connect in these COVID times
Yeah,
over the internet.
I know, especially after the extension of the lockdown. It's just going on and on, right?
Yeah, Sydney's in for a rough few weeks. Now, of course, we're not here to talk about the
Mhm.
Sydney lockdown. We want to sort of delve into what's happening specifically in the US markets today. We had the Federal Open Markets Committee meeting wrap up just yesterday, our time, and we've seen a pretty muted response from markets around us. So, first of all, can I get your take on what the Federal Reserve have put out to the market?
Yeah, so really, they said, progress is being made towards their goals, and they'll just keep watching things. They're not seeing sort of significantly sort of large enough changes in the data to say, okay, we're going to explicitly move timetables forward and so on. Still expecting that tapering is likely to start in September. So it was a fairly kind of even keel sort of set of minutes, and nothing that really sort of shocked people or surprised people.
Well, that's arguably, what we need to see from the Federal Reserve at the moment.
Mm.
You and I have had this conversation in the past, in past
Yes,
videos, that they can't come out and upset
yes,
the market, that the
that's right.
market really needs forewarning
That's
right
right.
now.
Yeah, yeah. So it's all about sort of trying to have that guidance. Difficult times to give guidance because they've introduced, new ideas, as we've talked about before. The flexible average inflation targeting. How do they sort of word that, the language around that? And secondly, things like, as one economist put it quite well, not just forecast driven, but outcomes driven. So sometimes having to wait for outcomes, and that makes it difficult both for the FOMC, but also people who are commenting on the FOMC.
Yeah, it does make our job difficult. But more importantly, I want to shift this conversation forward a little bit to
Mm-hmm.
gold. Now, again, this is something you've covered periodically in the past couple of weeks, but
Yes.
it hasn't really reacted to what the Fed did overnight. Can you explain why we're seeing sort of this lack of action in the gold price?
Well, I guess that it is partly a reflection on the sort of the content of what the FOMC minutes. And if we look at gold pre the minutes and pre the announcement, it's really sort of very range bound, 1790, maybe 1820 odd. If you wanted to narrow that range, the range 1790 to maybe 1814 even. And you could kind of see that the market was happy to settle down and not really try and push out of that range before any news came out. Now that news has come out, we're seeing the market firm a little bit. And that looks a little bit like there's some short covering going on out there. Nothing sort of, particularly notable. In terms of where I'd see the market moving today, still in that range, 1816, sort of trading through there. I'd expect 1824 to 1827 to be a first line of resistance. And partly that's because we've got short-term targets to that level, and also partly because that's where the resistance comes in on the daily Ichimoku cloud base. So that's where we're kind of expecting to see the market. It's still in a range, and that in itself tells you that there hasn't been any new news in that sense.
So basically the gold price is, factored in all the macroeconomic news going around, and there's nothing really it can react to right now.
Certainly, it's factored in that news that it has. So yeah, absolutely, absolutely.
All right, now let's move on to the meatier and divisive topic of inflation right now.
Oh
Now,
yeah, yeah.
I noticed just today when I was out getting a cup of coffee, the price of petrol has jumped 30 cents, and that's a huge amount for the price of petrol to jump in Australia. And we're
Yes,
seeing,
yes.
large jumps in inflation measuring data in Australia, same as in the US. And again, this goes back to a conversation we've had before, but these aren't quick conversations we can have
Yes,
around a headline. They're quite meaty subjects. Um, Tell me,
yes.
we've talked about this transitory inflation from the Federal Reserve Bank, but it's more of a nuanced conversation. So let's try and dig a little bit deeper here. What are we seeing with these numbers coming out of the Fed?
Hmm.
Is it truly inflationary environment that we're seeing happen in the US right now in particular, or is it merely reacting to other things?
It's a lot of it's about composition. So what things are going up, what things are sort of not going up. A lot of what the Fed is looking at is saying, well, they're looking at sort of, I don't know, maybe used car prices, various other things, eating out and so on. And what they're inferring from that is that a lot of the price rises are coming from sectors that are directly influenced by kind of reopening in the last quarter, and they're sort of saying, well, things that aren't really aren't affected by reopening themselves aren't moving that much. So that's why they're sort of taking the kind of like the transitory story. And they're always going to look at things that are fairly one-off, like a one-off shock. And they're going to say, well, it might be disruptive and it might be painful. Doesn't make it not transitory. And that's where that sort of language is coming from. So a lot of it's about the composition of how the index is made. Where are the really inflationary bits coming from? Where are they not coming from? So that's why that sort of whole contentious, issue where people are kind of, it's not transitory, it is transitory, and of course it's a finely balanced discussion. It's also a reasonably subtle discussion.
So if we look a little bit forward to the bond market, so what's the bond market telling us about inflation? Because this can be a good long-term indicator of where the inflationary pressures really are in the marketplace.
Well, there's two things that are notable. One thing is, if you look at what is the bond market's expectations of 5-year average inflation 5 years hence, which I know is a long way away, but it's a pretty interesting, it's a pretty common way of looking at it. That market is basically saying that inflation's not expected to be that high then. It's looking at about 2.25%. It's lowered recently. Quite interestingly, if you look at it in the sort of the post-GFC period, first sort of half decade post-GFC, when there was a fair bit of monetary support, as we know, and so on, actually the inflation expectations were significantly higher than they are now and remain significantly higher. So that's kind of telling you that the bond market, certainly in that time frame, is fairly sanguine about expectations. I guess what that could tell you, though, is you could have some disruption between now and then, because you're looking ahead a whole 5 years. So it's allowing for the fact that you might have price pickups in the course of 2021 that could reflect things like higher energy costs, economic reopening, which of course is threatened now by things like the Delta variant, but also one-off shocks and one-off inflation effects that could actually pass through in the next 12 to 14 months. But certainly that's one element the bond market is looking at. The other thing is, if you look at the 2-year, 10-year yield spread, yield curve, that's sort of relatively flattening. It's flattened quite sharply, or turned flatter quite sharply since the end of March. And that sort of ties in with the whole reflation move that we saw in Q1. Q2 has been all about reassessing that reflation move and actually being pretty pessimistic, in fact. And that reflects real world expectations, because if you look what's going on, so many economies are concerned now about COVID, lockdown, spread of Delta. That's at the forefront of people's minds. So it's not really surprising that the yield curve would indicate that actually they're pricing in lower expectations of growth. Now, circling back to inflation, lower expectations of growth in the bond market tends to take some of the heat out of the inflation story.
So how come then we get people suggesting that there are some people who look at the data and say that they're inflation deniers? Are we conflating narrative with arithmetic?
I don't think we're conflating narrative with arithmetic, but when it's, someone made quite an interesting observation that when there are things that are, complicated and changing, and of course, at the moment where sort of feel like a bit of a pivot point with this, you could look at 100 things, whereas when things are sort of trending quite naturally, you probably get away with looking at 5. We can't really look at 100 things, and we certainly can't talk about 100 things. So look, I don't think we're getting too hung up on arithmetic, but I think one of the things we're trying to do is talk about things how they are, and trying to pass things and sort of at least sort of give the key points here. What we can't do is, I guess, turn it into a sort of like a really, really huge in-depth discussion about it. We're trying to touch on the main things. I guess that's what your aim is and my aim is. Hopefully we are. One of the interesting things that we talked about, I think, last couple of days, was a lot of people focus on the expansion of the money supply, and that's important. But it's not the whole story. It's not the whole story, whichever economic school you belong to. And one thing that, for example, is really, really notable, it's part of the sort of money supply story, is just how the velocity of M2 has shrunk over time, but it shrank particularly last year, and it hasn't recovered. So that again is one of the the sort of money supply bits of the jigsaw that you've got to pick up off the carpet and remember that you got it, because otherwise you're dealing with half the story or a third of the story.
I like that analogy there. And finally, just to wrap our little section on inflation, I want you mentioned before off camera that there are risks going forward that we do need to consider, or things that the market might not be looking at. So could you expand a little bit on that point of view for me?
Look, there are quite a few things, and again, there's always the risk that when there's a sort of a turning point, and we know that the Fed and other central banks are considering when to taper, and then tapering leads to tightening. Everything around that in terms of timing is crucial. That's important. And again, it goes back to weighing up, transitory, not transitory, how inflationary, how not inflationary, how does growth pan out in 2021 and 2022. There's always scope for a mistake in that area, and the mistake might as easily be, tapering too late, and then having to sort of, tighten a little bit faster. Of course, the markets can kind of do that for you as well. Other things that are out there that are perhaps not in the mistake category, or the way that perhaps policy can be controlled, is if you're looking at some of the things that are going on in the Chinese stock market, and the sort of way that tech and certain sectors appear to be suffering under the regime. Is that going to feed? Is that a bigger story that in 6 months' time we're going to look at and say, gee, the plunge in Evergrande property prices, that was a little bit of a message. At the moment, it's not a message, but we don't know whether it's a message. So there are all these things that are going on. Nothing ever stops. So I'm not singling out Evergrande, particularly, but there are things going on that have to be assessed. But yeah, certainly the other thing is, it's a little bit of a topic at the moment, and I don't really know a good way of sort of summarizing this, but there are sort of some really, really interesting arguments and discussions, not only about the amount of sort of QE and when that ends, but also around some of the Fed's mechanisms for collateral and so on that are gradually becoming, certainly part of the narrative. Maybe we'll touch upon that next time. But yeah, there's always the scope for a mistake. Let's hope one doesn't happen.
Arguably, we can boil the risks down to like checking your blind spot while you're driving. Exactly. Just because, there's nothing there right now doesn't mean there won't be something 60 seconds down the road. Yes. Kind of take. Exactly. Now, Nick, you and I are working very hard to try and bring much longer chats between us to fruition. Yes. So everybody who is watching, stay tuned. Nick and I are in the process of bringing meatier market discussions your way. We'll keep you posted. But unfortunately, we have run out of time today, Nick. So first of all, I want to thank you very much for joining me. And I always appreciate your market insights.
Thank you, Shae, and you. Cheers.
See you later.
Sure.